Welcome everybody to product group meeting. I suppose I ought to kick it off by telling you about a couple of things that have been going on in the background. So as a group, NAS, ISTA, CBM have had a recent meeting with the Department of Business and Trade. Two ministers, both Chris's. One is business and trade, the other one is tariffs, imports, exports, because of basically the news around the fact that UK Steel, or in the guise of Tata Steel, are desperately trying to get the quotas changed again for steel imports. Rumours are abound that they are asking for a 50% reduction. So there are several people who are putting representations. We are trying to get a cross-party group together of members to represent downstream steel people, service centres, because they do seem to have a very big lobby group, UK Steel. So we continue to fight the good fight in respect of that. And we are hoping that they are actually going to listen this time, despite Mr. Reynolds' decision in June to change the tariffs from the 1st of July. As we pointed out, everybody said it was 4 days' notice, but actually it turned out to be 1 day's notice. Yeah, the decision was ratified on the 30th of June and put through on the 1st of July, which not many businesses can live with those sorts of things. And obviously it has cost many millions to the importers and the people who have imported steel. Another big effect on the steel industry is Jaguar Land Rover. I am led to believe that they are back producing, and the plan is ramping up to figures that they are hoping to get back to where they were. I don't believe anybody is thinking that they're going to work over Christmas to make up the numbers, but I'm trying to get a handle on that so that we can actually get to a point where we know what demand is going to look like. But obviously the effect is many millions, in fact billions of pounds to the UK economy on that cyber attack. One of the reasons for the people who are on the call today, so Tom's on the call today, we've got Jonathan Carruthers from MEPS and Colin Richardson from Argus Media, is to add a bit of a bit more information than I've got onto that, and to give you the current standpoint of where it is with regard to the economy and everything else. Obviously the news yesterday that unemployment raised to 5%. One of my other jobs is that I work in the pallet industry as well. There is currently a glut of pallets and the pallet price is down, which tends to indicate the distribution is also not as strong as it was. And we've also had the need for a couple of temporary drivers. And again, normally at this time of year, you can't find a temporary lorry driver for love nor money, but we've managed to drop on 2 this week. So again, another indication that the economy is not standing up to it as much as it can be. Obviously, we are awaiting another budget, and well, I believe that Keir Starmer might be a little distracted at the moment by people stabbing him in the back, but we'll see. We'll see what happens. So I'm not quite sure whether we have a running order, but I'm going to take it in alphabetical. Colin, are you there?
I am. Yeah. Sorry.
Yeah.
Thought I was on mute and I'm not. Yep. Hi everyone.
So I'll hand you over to Colin Richardson. Thank you, Colin.
You're welcome. Hi everyone. Yeah, my name is Colin. I'm the steel lead for Argus Media in London. I'm going to present mainly on flat rolled because That's really the only thing I know anything about. So I hope there's some flat roll people on the call. If not, I apologize. I'll bring up my presentation. Can everyone see?
Yeah, got it.
Yeah, I've got that.
Cool.
Thank you, Colin.
Okay. So I'm gonna focus mainly on Europe, because Europe's kind of leading the UK in terms of quota reductions and what Ian's already touched upon in terms of what Tata's asking for. And by the way, for anyone that doesn't know, there's also, as well as the the cut in quotas that Tata is seeking, it is looking for around 50%. Ian is right. They're also requesting a dumping case on Galv, and I believe that case will be formally initiated in the first quarter of next year. Haven't got that totally confirmed yet, but that's what we understand is going to happen. Again, it's not clear who the case is going to be on either, but I would suspect it's the usual sources of cheap galv into the UK, Korea, and Vietnam in the main, the ones that were most affected by the cap on the other countries' quota being implemented. So could see quite a different supply paradigm in Europe and the UK, sorry, as well as Europe. I won't really talk about Argus. We're a price reporting agency, got loads of offices around the world. We don't just cover metals. In fact, we're quite new to metals and steel, as some of you may know. Make most of our revenue from oil. We publish an oil price called West Texas Intermediate Crude Oil, WTI, and that's one of the world's largest oil benchmarks, and that's where we make most of our revenue from oil. But we are growing in steel as well, and we've got some important benchmark prices, mainly for hot rolled coil in Europe, which is, as I say, what I'll focus on. So there's a real, as everyone knows, there's a real demand problem in the UK, in the EU as a whole. Germany was the kind of the driving force of the European economy, and whether we like it or not, the UK is inextricably intertwined with the EU. So what happens in the EU definitely affects the UK, and the German economy particularly since the war in Ukraine broke out and the kind of the cheap energy from Russia stopped flowing to Germany to the same extent. They've had real problems. They've had this kind of double whammy of higher cost, and at the same time, obviously, China has kind of flipped from importing lots of high-end German goods, whether it's plant making equipment, whether it's German badges, German cars. The flip from importing to exporting, and they compete and outcompete Germany and much of the EU manufacturing sector as well. So yeah, the German economy has been facing some real headwinds for the last few years, and you can see that in this is a slightly busy slide. I'm sorry, but you can see the top right chart, the German manufacturing weakness. You got the light blue line, which is new orders, and you can see that new orders have tanked, and at the same time inventory has increased. So these lines are kind of diverging. What one would hope that in the next few years, as the kind of German bazooka stimulus that they've announced, if that actually amounts to anything, given the political fragmentation in Germany, you would hope to see these new orders tick up and the inventory fall, and then this graph would look a bit like a fish. Doesn't look like a fish just yet, but maybe in a few years it will. German industrial production has been tanking. It was obviously you see this trough in 2020, which was caused by the pandemic. Then it's increased somewhat, and then again over the last few years, it's come off because of that Asian competition, because of the higher energy cost, and because of some of the complacency probably in the German economy, and not just the German economy, the wider EU economy, in terms of people not investing sufficiently in their kit, whether it's steel makers, whether it's other manufacturers. They've been leapfrogged by Asian competition to a large extent, and obviously that's been compounded in recent years by the tariffs that have been imposed in the US, firstly on steel, then on downstream goods, then on many other goods from Europe and the UK to a lesser extent. So the economy is really struggling over the whole Eurozone. Italy and Spain are growing, and growing quite well, surprisingly. They're kind of the strongest economies or two of the strongest economies in the EU at the moment, but they're not big enough to drive the whole Eurozone. Germany is the kind of the economy that could do that because of its size. So where it has its economic problems, they have an outsized impact on the whole EU and the UK as well. And then we've got lots of policy uncertainty, and which again Ian touched on. It was a really interesting TRA announcement the other day that they're looking at the exemption of Vietnam from the rebar quota in the UK. That was because I think about 20,000 tons of Vietnamese rebar was imported in the summer by a trader, because Vietnam has been exempt because it's been under the 3% WTO threshold, so it hasn't qualified for the quotas. As soon as that vessel's come in, then UK Steel, on behalf of CELSA, has started lobbying for Vietnam to come into the quota, and that's one shipment, probably one shipment in the last decade or so of Vietnamese rebar to the UK, and suddenly they're going to be, essentially in the other country's quota from the 1st of January. There's another vessel that will be on the way from Hofat. I think another 20,000 tons brought in by another trader, and that's going to be a real problem unless they can, divert it elsewhere or call force majeure or whatever. You're going to get stuck with a massive duty on 20,000 tons. So it's quite this kind of policy uncertainty over trade, the wider policy uncertainty with the US, with the kind of changeable relationship between the US, between the EU, its major trading partners, China, and the wider implications for the economy they've had. This has all contributed to a pretty slow steel market. Real demand has been low, probably since 2000 really since the COVID years. You've had this big kind of increase in spending, consumer spending during COVID. People buying, people getting extensions, buying new cars, new washing machines. And what happened is a lot of that demand has just been pulled forward, and it's now effectively disappeared. So there's a lot less spend on steel intensive goods, consumer items, whether it's white goods, autos, whatever. You can see that in car sales figures. At the same time, you've had lots of competition from Asian brands into the EU, into the UK as well. Notice now I guess you all drive around the UK, the amount of BYDs that you see, or JQs, which look a bit like the Range Rover Evoque, or the little MGs that you see. They're everywhere. There's so many more imported Asian cars, and yeah, EU and UK manufacturers struggle to compete with them. The issues at JLR that Ian touched upon have had a huge impact on the economy, and obviously on the steel supply chain in general. Their call-offs have been zero effectively, so there's a lot more stock in the system than there should be, and the system was already overstocked. So the demand scenario is pretty poor at the moment, and there's no real. I don't think there's. I'm not an economist, but doesn't look like there's any real impetus for it to change. I think the Labour policy in the UK hasn't really been to stimulate investment. I think it's fair to say. In the EU, there's a lack of investment as well. And what you really need is like a black swan event, like the war in Ukraine to stop and for reconstruction to begin, or something else to happen that is a big demand trigger. And short of that, it seems unlikely that there's going to be a real change in demand in the next 12 months or so. So yeah, the demand side equation is quite poor. At the same time, we've got a well-documented supply problem in the global steel market. Chinese exports have absolutely ballooned, and I'm talking about exports of hot rolled here. So if you think back to 2015, 2016, China was exporting around I think it was 112 million tons exported in one of those years, which at the time was more than Japan produced, and Japan then was the second largest steel maker in the world. And these exports obviously dissipated to an extent, but what's happened recently is because of the property market slowdown in China, and the related slowdown in construction and infrastructure spend, more Chinese mills have pivoted from producing long products, and they're producing more hot roll, more cold roll, more galv, more plate as well. Although the plate market is weirdly quite strong in China right here. So basically, the face of Chinese overcapacity and exports has kind of changed. So it's pivoted from being very longs focused to being very flat focused. And you can see on this chart, hot rolled coil exports in 2024, nearly 30 million tons out of China. And if you relate that back to 2015-16, when they were exporting more steel than the second largest producer made, they were exporting something like 6 million tons of hot roll, maybe even less. And that's just had a dramatic impact on the global marketplace. And you can see the response to that from the increased trade measures. I'll talk about the EU in a little while in terms of its quota revisions or potential quota revisions, but everyone is building barriers to Chinese steel. Even countries in ASEAN that have been big buyers of Chinese coil, like Vietnam. A lot of China's exports of hot roll go into markets like Vietnam. They've started. They've put dumping duties in place. Egypt, which has also been a fairly big buyer of Chinese hot rolled, they put in a safeguard on hot rolled coil and some other semis as well. Korea's investigating Chinese hot rolled. Brazil's got a steel safeguard. The US, as we know, has got $1.2 million tariffs on China and everyone else. You've got the UK looking at changing its quota. So there's this big kind of this export boom out of China on flat products has sort of collided with an increase in populism and political and economic populism and what I've termed resource nationalism on the chart, and that's mainly referring to the likes of, let's say, British Steel, our remaining blast furnaces. There was this sudden urge that we should keep them for our defense capabilities, even though they don't really supply any steel to defense, and even though the heavy end is knackered and the blast furnaces are ancient and they don't run the coking coal ovens anymore. You got this kind of desire to retain primary iron and steel making, which is, because of the wider geopolitical uncertainty we see, the war in Ukraine, kind of strife elsewhere, Russian drones encroaching on EU airspace, all this kind of stuff. That's kind of collided with the booming exports out of China, and it's not just steel. China's exporting a lot of its cars, its fridges. I was talking to a Russian steel mill the other day, and Russia is obviously it's not in the best position at the moment because of all the sanctions, but their steel mills are good. They're very, very low cost. They're probably the lowest cost in the world. And one of the mills that sells into Turkey, and obviously, the Turks will buy from Russia, whether sanctions are there or not, it doesn't really matter. One of their Turkish buyers that was taking cold rolled, I think, to make white goods like fridges and home appliances, has turned around to them and said, "We're not buying from you anymore because we're buying the white goods from China." And that's that's kind of the problem in a nutshell at the moment is just the amount of supply chains that have been cornered by China and the huge exports of these products that people elsewhere can't compete with. That's had a real impact on not just on the steel market, but on the global economy, on every facet of business really. I won't talk about CBAM too much because I don't fucking understand it, frankly. But it's another real headache for the EU markets at the moment. No one really knows what the cost is going to be. People were assuming it would be 30 to 50 euro per ton increase on imported steel, and now those kind of expectations have shifted up slightly because the EU is going to review the benchmarks under its ETS, its emissions trading system, and those benchmarks, the ETS benchmarks, which are for domestic production, they will inform the benchmarks for CBAM, and basically the benchmarks for domestic mills are going to be more stringent as we go forward, and there's also going to be a reduction in the amount of free allowances that domestic mills can purchase. So people have kind of increased their expectation of what the CBAM cost is. So it's kind of shifted from 30 to 50 to 50 to 70, but there's a lot of uncertainty. We don't know what the benchmark is. We don't know if there's going to be default values on certain countries or whether they'll be able to self-report. And frankly, it's an absolute mess. The Commission has been preparing for CBAM supposedly for, I don't know, 5 years or so. And it just seems so last minute, and no one will actually know the real benchmarks that they're having to deal with, which will inform the cost of the steel that they're purchasing until, and they'll have to be paying, or CBAM will be payable from January. You don't have to purchase the certificates until 2027, but you will in 2027 have to purchase them for 2026 as well. So effectively, you'll have a double payment in 2027, which is probably quite inflationary and probably not great for the broader economy. I've kind of touched on this, but the prices have been again, I'm looking at flat products here, but I think it's the same for the long sphere as well. They've been fairly subdued. You can kind of see this pop in the last couple of months, I guess, in mainly in the EU, not so much in the UK, driven by expectations of the tighter quota, driven by expectations of CBAM cost, etc. Domestic mills have pushed up their asking prices. There's also been a lot of, in fact, a really strange amount of domestic production disruption in the EU. So you think you had the blast furnace went off at Fossummer, Arcelor's plant, so they've got no blast furnaces working. Then Thyssen's hot strip mill 4 in Duisburg, which was only commissioned in, I think, May of this year. That caught fire a month or so ago, or a few weeks back. So that's offline. They are able to, for now, kind of reduce the disruption because the other hot strip mill that they were going to take off in Bochum, they're going to keep running. So there's no massive impact on supply, but it's basically feels like the market's going to be much tighter next year. and because of that, the price has increased. But at the same time, because demand is very constrained, both real demand and apparent demand, no one's really paying. No one's buying substantially into these higher prices. Everyone's really hand to mouth. Everyone's just buying what they need. No one wants to take a position because no one really is confident that that there'll be like a sustained rebound. There probably will be once the new quota comes into place. Again, there's been a lot of uncertainty over when it will come in. Probably will be the 1st of April. The EU Parliament will vote on it in February. So for my money, it will start the 1st of April rather than the 1st of July. And the UK is obviously going to look to follow suit. So, the people often forget that the UK is quite a different market to the EU. The EU has a plethora of steel mills. We've basically got one for each product, and imports are, I think, 70% of steel supply, which in fairness to UK Steel is probably a bigger number than it should be, but we don't really have that many mills that can service the domestic demand. So if you see a 50% cut in quotas in the UK, it'll be an incredibly different marketplace in a year's time. A lot of already on the flat steel side, on hot rolled, the amount of decoilers, the amount of service centers is shrinking. It's consolidating. You've got like a handful of big guys now who decoil hot rolled, and what's happened is the smaller guys who have traditionally, bought from import and taken some forward risk because of the difficult market, because of cash pressures, they've kind of they've let the big guys warehouse the risk, the likes of USP and others, and they've just bought smaller quantities from them when required. But if we do see a huge cut in import quotas, obviously it'll be the import quota for everyone that isn't Tata, Top Tubes or Marchigalia. It'll have a really big impact on those smaller guys who've been buying from the bigger guys. May find it much harder to to purchase cheap steel going forward. So everything's really depressed at the moment. It will probably be a very, very different, leaner marketplace in a year's time, I would think. The chart on the right here is the Italian hot rolled domestic premium versus the import price into Italy based on August data, and you can see it's massive. There's a €120 spread, which typically the kind of the sort of sustainable difference between domestic and import in the EU is around 50 euros a ton. Any less, it's not really worth taking the risk anymore. Then the domestics have to react and they have to drop their prices. Right now, the spread's massive, but the spread will obviously shrink because you have CBAM and you have all these import curtailments coming into place. I think this just demonstrates one of the problems that the market has had in the EU and in the UK is imports have been so much cheaper than domestic material. Whether you blame the importers or the domestic mills for that is, it's a personal call, but you can't deny that imports have outcompeted domestics, and that's had a big impact on the market share of domestic producers. In the EU, probably 40%, 30-40% of hot rolled is imported, and for galv and cold rolled it's even more. And in the UK it's even more again. 70% of the market's imports. I think that talk about the right side of this chart first. So the the HRC exports to the EU. So this is customs data for the rest of the world shipping into the EU. It's not stuff that's landed here yet. And you can see in August, you got this huge uptick in exports to the EU of hot rolled. It was driven by Indonesia, by Turkey predominantly, but there are some others as well. Ukraine shipping quite a few volumes to the EU now. Obviously, it's exempt from the quotas at present, and this is people trying to buy ahead of CBAM. So everyone trying to get fourth quarter material, so they don't have to pay the CBAM duty. The September bar looks quite small. I think that's because the data set's incomplete. I don't think it will be that small, in a couple of weeks' time. And again, I think the October stats will be really big as well. And just in the last couple of weeks, anyone that's got short lead times has found lots of demand in the EU in terms of hot rolled sales. Don't think it's been the same case in the UK because the market's looser, there's more inventory on the ground. In the EU, India's probably sold 150,000 tons of hot rolled in the last couple of weeks. We're exporting to the EU. The idea was to get that for November shipment and get it in ahead of CBAM, but the quota won't be there. So some of it, even if it does arrive in December, have to wait until January. So the Indian quota will probably bust quite quickly in the EU in January. The Turkish quota will as well, definitely. And all that material that looks, it looks quite cheap based on this import spread. It won't be quite so cheap because it'll pay CBAM, whatever the CBAM duty is. And then this chart on the left is just showing how everyone, I think in the UK, in the EU, everyone feels overstocked, or at least on, the decoilers, the service centres I speak to. Demand is low, so everyone feels like they've got lots of inventory. If you actually look at the, this is based on the German Stockholders Association data. If you look at the ratio of stock to sales, historically, it's actually quite low. Though I think the one that stands out for me here is Galv. Galv is the bottom line. And you can see that the stock compared to sales is at its lowest point for a couple of years. And that's because the German economy's knackered and there's not much demand for Galv, and everyone's been, basically liquidating their inventories ahead of the year end, ahead of the financial year end to generate cash, which often happens in Germany, often happens in other markets as well. But you have this kind of reduction in inventory, which is also it's a effect of the higher interest rate environment and the fact, people are much more hand to mouth these days. People have been burnt so many times that they typically don't take big positions and don't hold, don't like to warehouse too much risk. But if anything does, if there is some demand event, it won't take much for the price to absolutely fly because there's going to be huge supply curtailment coming through, which the market's not feeling yet. It kind of knows it's coming, but because of the cash flow issues, because of the weak demand, no one's really in a position to, even if they wanted to, go long, buy more tonnage, no one's really in a position to do that, or I don't feel confident doing that. But for me, there's a real risk that the market will kind of jump if there is any slight sort of demand side impetus. I'll fly through these slides because I know I'm waffling. Yeah, CBAM, mentioned it already. The cost itself, it's not actually that hard to work out. The cost is the embedded emissions of the steel that you're importing, and this will be the same in the UK when it happens as well, minus the EU benchmark, which we don't know yet, times the benchmark factor, which is 97.5%, and then multiplied by the price of carbon under the ETS. Price of carbon at the moment is around €80 a ton. So if you're using the leaked benchmark that we saw for the ETS value for CBAM, price of importing blast furnace hot rolled into the EU is probably going to be about 60-70 euros higher than it currently is, which is substantial, right? You can see that the 490 CIF Italy hot roll price becomes 550, 560. But again, we don't know what the benchmark is going to be, and all of that uncertainty doesn't help because if people knew what the cost was, they would be able to better position for the reduction in supply that's going to come down the road. But because of the risk, no one feels, quite comfortable in doing that. And this is my last slide, and I think probably my best one as well. So this is just looking at let's look at the left-hand side first. If you look at the dark blue bar is what the EU imported in 2024. The reason I've used 2024 is just because it's full year. The light blue bar is what will come in under the new quotas, and the yellow bar is the shortfall, so the difference between 2024 imports and the new quota. And you can see the differences are really big. So on hot rolled, it's a drop of 40% plus. You've got, I think it was new quota is going to be about 5.2 million tons. Imports in 2024 was something like 8.8. So you've got a 3.6 million ton drop in imports. And really importantly, which I don't think everyone grasps, is the new quota. There won't be any exemptions. Maybe Ukraine will be exempt, maybe, but it's not clear that it will be. So anything that is imported into the EU will be in this quota. There won't be any out of quota imports unless Ukraine is maybe there, which is another million tons or so a year. Everything will be within that. And the duty will be 50% out of quota as well. So doubled from 25%. Obviously, it'll still be prorated. So if everyone clears material on the 1st of April and the quotas bust, you share that 50%. But obviously, if you're sharing 50%, it's a lot more cost than it is sharing 25%. And again, this is something I don't think people are totally grasping, is there's going to be a cut in quotas of 47% or something broadly across all products in the EU, but the actual import will probably drop slightly more because the risk reward balance is totally skewed for importers, because 50%, if you get it wrong and you have a 50% duty, that's it's an existential threat to your business. So that's going to have a really big impact on supply into the EU and into the UK as well, because the UK will do the same thing. And obviously it's not the reductions aren't just about increasing price. They're meant to increase utilization rates for domestic producers. The idea is that EU producers can regain more market share, that their economies of scale are better because their fixed costs reduce, their utilization is higher. That's supposedly what the measure is designed to do, but obviously it's probably going to be inflationary price as well. And one of the most interesting yellow bars is the cold rolled bar. It's cold rolled. It's a much smaller market than it used to be when I started writing about steel. I started in 2008 for SBB because I'm that old, and it was back then it was a different market. CR, it's kind of shrunk because like a mill like ThyssenKrupp has hot rolled at certain gauges that you can use instead of CR, and because the extras on CR are so small compared to Galv, EU producers are, there's no point in them producing that much CR. They may as well galvanize it and then they can benefit from higher extras. The only extra you can get on CR, as far as I'm aware, is really a dimensional extra, and it's not that much. Galv, you can make more. So it's a kind of low profit product that a lot of the domestic mills have stepped away from. You can see it in the UK, right? Tata's stopped making it for external sale. They're only using full hard for their own galvanizing. But the drop in the CR quote 50% in the EU, and at the same time there's an anti-dumping case on 4 countries, and those 4 countries, I'll try and remember who they are, I'll probably forget. I think it's India, Taiwan, Japan, and someone else, I can't remember. They're basically 60% of the EU import market for CR. So you've got a 50% drop in quota for cold rolled coil into the EU, and then you've got 60% of the previous supply is at risk of dumping duties. So imagine what that supply scenario looks like when the new quota is in place. So anyone that buys cold roll to make white goods or is a service center that is servicing, Electrolux or whomever it may be, they're going to have to reorientate their entire supply chain. They're going to have to move away from imports, and they're going to have to buy domestically on the assumption that domestic mills will actually produce more cold rolled, which obviously they haven't wanted to in the past. So my conclusion is that demand really weak, market really bad. Next year will be a much more leaner market, purely based on protectionism rather than any increase in demand or rather than any change in Chinese fundamentals. I don't think fundamentals in China will change one bit, but the EU will be much more, protected from those. It'll be more of an island. The UK will also be more of an island because it will follow suit. So yeah, it's going to be a really different marketplace from my point of view. I'm sorry if I've waffled on, and thank you very much for listening.
Very good, Colin. Thank you very much. Very interesting.
I've just realised that I was really gesticulating, really using my hands, and I have my camera off. It's like, what's the point? Anyway,
it's not a problem. Does anybody have any questions for Colin?
Yeah, hi Colin, it's Tony Feek from Target Steel. Sorry I arrived a little bit late. Greetings to everyone else as well. What do you think will happen in the UK? If I missed that first bit, I apologise. But what are you expecting? What's the inside gossip at the moment? Because I'm not hearing a hell of a lot in terms of how will the UK government try and protect the UK steel industry, and will we follow the European model? What's your thoughts on that?
Yes. Yeah. No. So I don't know if you know Peter Brennan. Tony used to work for me at Platts, and he now works for UK Steel. So I talk to him quite regularly, and he says to me that the UK government didn't know that the EU was going to change its quotas. It's been totally caught off guard, so they've obviously not been reading Argus. But yeah, they're obviously going to have to do the same thing, right? And it's not just the problem now is it's not just an EU thing. Like there's protectionism springing up everywhere, like literally everywhere. You know, I mentioned it before. Egypt, I think Morocco, Brazil, Vietnam, Korea, India. Everyone is trying to protect their domestic producers. Whether that's a good thing, you know, maybe it's not, maybe it is. There's also going to be in the EU, there's a big lobby at the moment from Eurometal, which represents traders, distributors, and service centers, to have downstream measures. So components, semi-finished goods that are steel intensive, they want all of these things to be dutied as well and to have a safeguard in the EU. And I think they'll probably get it. It will take some time. It won't be until 2027 from my point of view, because it's a massive undertaking given the amount of CN codes and HS codes and stuff they'll have to look at. But there's globally the trend is protectionism. The UK will absolutely follow suit. It's a different market. You know, I said before, we've got 1 mil for each product, so it's a super different market to the EU. But I think the UK government will basically just do what the EU does, hopefully to a less stringent extent because of the different supply composition that we have here. But yeah, I think there'll be definitely big curtailments of quotas. And then I mentioned before, I don't know if you missed it, there'll be a dumping case on Galv as well. Vietnam, Korea, maybe some others too. That'll probably come in the first quarter.
And just one other point from my side. Southern Ireland, a lot of us on here, the stockholders, will export to Southern Ireland, and Northern Ireland is the same. Obviously, that comes under the European quota. Do you think there will be any exemption, or do you think that will simply be, guys, as from the 1st of January, you know, you're going to be in the same position. You've got to watch and observe the same rules.
Yeah, I'm not an expert on the Windsor framework or whatever it's called, but yeah, I think it'll be really different. I think Ireland will go from a very import-led market to a very EU/UK domestic led market, because I think that the measures will apply to Ireland as they do to everyone else, and there won't be any exemptions. But you know, I don't know for sure. That's just my gut feel.
Just to add a bit of meat to that, Tony, as well, I was speaking to Mark McCausland from Sebden. He's written to the DBT for the rules on CBAM 3 months ago, and he's still awaiting a reply, even though it's only now 5 weeks, because obviously he's got place in Northern Ireland, shipping to Southern Ireland, and they still haven't given him the instruction, and he's saying, well, how can I work this way?
It's massive, isn't it, for them, for Sebden, yeah. Yeah.
It just seems to have caught the UK government on the hop that they just haven't cottoned on to the fact that they need to sort this out.
Yeah, definitely. Yeah. Thank you.
Does anybody else have any questions for Colin?
That's good.
No.
Hello, it's me. I've got one question. Hi, Colin.
You look different, Nigel.
Yeah, I know. It's actually me. It's not Nigel. It's me. It's Ed. I'm just wondering, with the safeguard quotas that the UK will announce, which I've heard is going to be in the next few weeks' time, are we expecting anything to do with coal reduced at all or electro galvanized? Because at the moment, obviously, those two products, in my opinion, well, they're some of the importers are selling into the UK at prices which don't relate at all to any EU prices.
Yeah.
Is there going to be any action on that at all? I was aware, I have been, I obviously keep my ears to the ground quite a lot, and I have heard that maybe some mills or countries are going to be investigated, possibly. But on the basis of what? I mean, because obviously those three products aren't made in the UK anyway. But do you think, in your opinion, that those going to be looked at all?
So I think you can't really have let's say dumping duty. You can't have a dumping duty if you don't have domestic production, because what you're protecting. And the other thing is, Tata Steel imports Korean cold rolled coil. So
Yeah.
why would they want to?
But the thing is, obviously, we can't. I mean, as stockholders, I mean, it's quite rare to buy absolutely everything on a 6-month forward lead time, especially with volatility that we're seeing at the moment. So does that mean that we have to buy from South Korea, Japan, on a 6-month lead time for one of the worst products if the market goes down, which will be leave everyone quite susceptible to losses?
I
mean, obviously, and obviously you've got people like Arsenal and all that kind of stuff. I mean, their prices for EU CR at the moment is astronomical compared to the UK prices.
Yeah.
Does that mean that we have to buy forward all the time, 6-month lead time with traders, which I don't mind doing, but obviously the prices are so different, it doesn't really make any sense at all. I mean, we're right next to the market, we're right next to the EU market, and the prices are so different.
Yeah, it's a crazy dislocation, Seb, isn't it? It's one of the I've been thinking, why can't people in the UK sell CR to the EU? But obviously, you can't, because if it's Korean cold rolled coil that you've just cut to length or whatever, it's still Korean cold rolled coil. Would come under that quota. But it's one of these dislocations that normally someone takes advantage of, and then it disappears because there's some regulatory action to stop it. I don't know if it'll happen, to be honest. I think as long as you've got a domestic producer that doesn't produce for merchant sale and imports itself, because it can, why not? Then I don't know what the rationale would be for having a dumping duty. I mean, I can see why we need one, because as you said, you can buy Korean cold roll for, cheaper than you can buy Turkish hot rolled. It's bananas. It's a really crazy thing. And probably Japan as well. But yeah, I don't know if it's going to change, mate, to be honest.
Yeah.
Not sure.
This space.
Yeah.
Whenever that will be. Does anyone actually know when the UK is actually going to announce these safeguard quotas? I mean, I was privy to information it was going to be the next couple of weeks.
Not from our meeting with the DBT. I think there's an awful lot of to-ing and fro-ing to be done at the moment.
Right. Okay.
So I don't think it will be in the next couple of weeks. We've got the budget to come out, obviously, and we've got a lot of other things that they're working on. But I don't think it will be in the next couple of weeks. But having said that, the way it's being run at the moment, you never can tell. But it's unfortunately, it just does seem to be an absolute bugger's muddle at the moment as to that. It didn't help that Jonathan Reynolds obviously made the decision and then buggered off to be chief whip. So the two Chris's are trying to pick up an awful lot of work, and trying to balance the books with regard to the budget. So I hate to criticise them because they have an awful lot of food on their plate, shall we say, to deal with. But they're not. Let me put it this way: I'm hoping they're not going to make any announcements in the next couple of weeks, because to me it will be half baked. They do need to get a grip on it. and you know, they do have some steel industry background, so I'm hoping that they're going to push back and hold off on it.
Right. Okay.
Yeah.
All right. Okay.
Right. So I am going to move over to Tom Bryant, who will give us some feedback on the market and trade credit at the moment, please, Tom.
Yeah, morning, guys.
Morning, Tom.
That was brilliant, Colin, by the way. Really interesting. I always, whenever I come on these, I know I can never beat you guys when it comes to talking about the market. So what I've got, just to, well, mostly talk about is our claims history, what we're doing with it and what we're seeing with regard to trade credit. So I'm hoping you can see that.
Yes.
Yeah.
I can see it.
Yeah.
That's
So essentially, we can't put the numbers in. Very conscious Shannon's here as well, looking at all of our trends.
Thank you, Tom.
But what we can see for the last couple of years, things have been, from an insolvency point of view, certainly from a claims point of view, things have been relatively normal. I'd say they've probably been better than normal the last couple of years. Certainly 2023, we've had some, as you can see on the left, there's some really spiky months where we had a couple of large construction companies go. I think it was Buckingham Henry, which kind of really changed the dynamic of the whole year. Without those, it probably would have been a good year. Last year was kind of okay as well, but this year, surprisingly, given how negative the whole market's been, this year generally insolvencies have been high. But I can't pretend that claims have kind of followed suit. We've had a number of very small claims, a number of very small companies going insolvent. But generally, we haven't had any real spiky events. This is specific. This isn't specific to any sector. This is our entire book. So certainly for the first half of the year, it was looking like quite a good year. No real big construction companies went. Which is where most of our, or a large chunk of our insolvencies would be. Our book would be. Same with retail. Anything that has gone has kind of been spotted, has been on life support almost for a long time. So nobody's really got caught on anything heavily in the retail sector or even hospitality. The thing to look at though is when we look at August, September, October, there is a definite spike in the insolvencies that we've seen, and being honest, they tended to be in construction and in our sector here. Certainly, when we had C Brown go, I don't know if what the actual numbers are. I've tried to look on the administrative statement. It doesn't seem to have any real figures, so I don't know the exact numbers on there. But certainly, we're seeing an uptick in claims from our sector in metals and engineering. And anything leading into construction regarding from the guys like yourself. And it does feel like that may continue. There are, Uni Metals went as well. Again, we don't know the figures of that, but that was, I know that scrap is not necessarily service centres, but it's another one that is likely to create issues for us and the rest of the market. And it certainly feels like claims and insolvencies over the last couple of months have increased. And I'd expect them to continue in that vein. And I think as we go into quarter one, I always say I like things boring. I like things, stable. And I think as we go into quarter one, when you've got CBAM coming in, when you've got quotas being changed, when you've got people changing their normal kind of supply chains, reshoring, nearshoring, I should say, worrying about whether that CBAM's going to be applied, whether prices are going to go up, are people trying to get more in November, December? There is a bit of concern that the cash flow for January, February, March, where people are unsure and changing what they're doing, if the demand seems to stay low, which it is, I can't see any reason why it's going to increase. If that does stay low.
Sorry, Tom.
Yeah.
Colin, do you have a question?
Yeah, I did. Just on Uni Metals, Tom, have they actually? So I know that they filed 3
Yeah,
notices to appoint. Have they actually gone now, or?
I think I saw one. It might have just been this morning. Actual administrators appointed, but I might have misread that because, as you say, they did keep putting it back and back. But yeah, I think they might have actually gone. I can't see, given what was going on there, and I don't know how much is known, so I don't know how much I can say, but certainly they were continuing to look for further investment. And I can't believe anyone would come in to a business like that and put more money in. Because let's be honest, it's scrap. It's a low margin business. When it was under Sims, it never really worked anyway. They never really seemed to make much money. So when you add debt on top of that, I was never really sure how it was going to work. So yeah, I think so. If someone could check during this, that would be that'd be great. But I'm pretty certain that I did see it, an actual administrator appointed, and that could create some issues in the market. But it's also worth noting for us that is scrap. That's different to what you guys do. So we don't want to, tar everyone with the same brush. Just because it's got metals in the name doesn't necessarily mean it'll affect the cover that we write for you guys. But yeah, going back to the cash issue, I think claims are always worst, or normally, this year was strange, are worse in the first quarter, and the lack of demand that we're seeing, coupled with a potential cash squeeze, depending on are people getting in further stocks early? Are they waiting? Have they got the stocks? I don't know. So there could be a continuation of these claims upticks that we've seen going into the next year. Just looking at the major sectors that that you guys feed into. So normally looking at the PMIs for construction and manufacturing. Certainly for manufacturing, it suggests that there's been a real big uptick. Things are going well, or not well. It crept right up to 49. I think it's 49.7. So almost at that 50 mark. That does kind of include the big rebound of JLR. When they start, the production coming back to more normal levels, we probably will see a slightly higher manufacturing PMI, but I don't think that is relative to the rest of the market. There's a few bright spots that we can see. Certainly renewables seems to be, data centers seems to be going from strength to strength. And the online kind of presence of warehouses seems to be going okay. But generally, it's just flat. Everything's really flat. Construction as well seems to be struggling. Their PMI was down at 44, very low, and I think some of that was pulled down by residential. Certainly, they're not going very well, but there's not too much steel involved in residential, so it's not too concerning. But civil certainly does seem to be down, and the start of new contracts does seem to be down. We've been saying for a while that companies seem to have good order books, be it in civil engineering, commercial, all of the waterworks, all of the but these projects keep getting delayed. They're waiting for sign off on planning, so all these projects that are ready to go, planning is taking time. It just means in the last few months where things were going okay, things have really stalled. And I don't know if it's an act of government to let a lot of these contracts go, start greasing the wheels with the electricity, with the water, rail, all of those infrastructure projects where most things are kind of being tendered out, but they're just not starting. So we kind of need that to kick on, be a little bit more of a doomsayer when those things do start to kick on, where people's cash flows are and availability is relatively low, because they've had to keep paying people, keep paying for products while we're waiting for these contracts to start. If there is a raft of them that all start at the same time, suddenly they've got the other issue of having enough staff, having enough cash to be able to facilitate all of these contracts going forward. So I'm always trying to be positive, but it does feel difficult to know what's going to happen into next year. It's not just, you know, the CBAM and the quotas issue. There's so many other issues out there, and the government, the budget's coming up. I don't know how that's going to affect things. Certainly when we had the NI thing came in earlier this year, anyone who was looking at doing investment put it all on stop because they didn't know how it'd be affected their own personal cash flow. So there could be another lost month or two, depending as people, you know, reassess and decide what they want to do. So overall, we seem to be, because claims are relatively low, they are in the uptick, but we don't have any real need as yet to do anything with regard to cover. Still happy to write, still do everything case by case, because we know there's good companies out there, even if they're in really bad sectors. So that's how the underwriting is kind of going on, individual companies. And we know how the cycle for steel and the market is working. So I can't pretend I'm looking at a lot of managements with huge profits like we were a couple of years ago. But as long as we're aware of, you know, headrooms and cash flows and what kind of working capital people have got, we're quite comfortable where we are. It still remains one of the better sectors for credit insurers. Supportive. Things are getting tighter, but as it stands, still like you guys, and we're still writing, hopefully, because prices have been depressed and not going up or down too much. A lot of cover that is in place isn't being removed and is good for you, and you can continue to trade as you see fit. Certainly, we've been writing more and more, even on the reduced positivity of the management accounts, just because we at least getting that information in, and we understand how the market goes through the cycles. So hopefully not seeing too much of a squeeze on any cover. I've not heard of anything, but if anyone wants to let me know, that would be good. And I'm assuming the rest of the market is doing similar to what we're doing. I've not heard any different anyway.
Sorry, Tom. Going back to Jaguar Land Rover, I'm led to believe that they currently have a scheme for their downstream suppliers, bit like invoice discounting, that people can join, but people are struggling to join on to it because a lot of them are already with invoice discounters. And
you
can't double up.
I don't know too much about it. I thought, being honest, I thought we'd see a lot more fallout from that we have. Admittedly, we haven't got, I've rightly or wrongly, I guess, kept our automotive book relatively low, and I thought we would have more of a fallout, but we haven't had too much with regard to overdues coming in. There have been some, but I think when it comes to the supply chain for automotive, and kind of similar with yellow goods and what have you, costs are a lot more to move suppliers for a set product for their set, you know, be it the Evoque, whatever it may be. If you need to do the retooling, it costs them a lot more to change their supply chain. So they're going to be very supportive, just because if they can still get those products in, it makes their production far smoother. So it wouldn't surprise me if they do everything they can and the fallout isn't actually as bad as we expected. If it is, it will be the much smaller guys than the tier ones and tier twos, I suspect. But no, I couldn't tell you too much about the
my understanding of it is that the support lasts until March 2026. So it's going to be March, April, probably going April, May time in 2026, where people may be not getting paid because they've already had the money up front. So I think it's seen as a short-term support. So anybody who has got sort of needs to get a bit of information from their customers if they are.
It should kind of be that it is a short-term issue. The bigger issue next year would be any kind of exports to the US, where there's now I think it's 100,000 unit cap, where they've missed a lot of this year's cap. They may have to stem production next year from that point of view. That may be a little bit further. But no, I would fully expect them to support, and I don't, very much touching wood, I don't think there should be too much fallout because of that support, and it should only be short term in theory.
Yeah. Right.
While they get back up to speed.
Does anybody else have any questions for Tom before I ask Shannon, before he retires, to have a few words? Any questions for Tom, or can I hand over to Shannon? Shannon, do you have anything that you'd like to?
Probably yes. Good morning, everybody. Probably similar to Tom. Claims have been quite steady, not as high as we would have anticipated. We've avoided the severity claims, and where we have had the failures, I mean, certainly C Brown was one that probably came very quickly, new ownership, and within sort of 14 weeks they were filing a notice of intention. So that was a very sort of, things unravelled very quickly there. But there's one particular supplier that was probably about 65-70% of their supply that wasn't insured for us, and what we were able to do was advise clients to very quickly contact Teneo, who are the advisory firm, before they got appointed as administrators, and ensure that any stock delivered subject to retention of title was ring fenced and could not be sold or moved without the supplier's consent. So I think that kind of minimised any potential damage there. So yeah, the sort of loss ratio is running at a reasonable level, and sort of approval levels have been held very steady as well. And to take my hat off to NAS members and the sector in general, that they're very proactive in advising us where we're likely to see a large application on them, and if it is to replace an existing supplier, it helps us reshuffle the cover around as well, which and that kind of proactive steps that members take is very, very helpful. Because whilst we can write the cover, it's sometimes when you see your exposure, which is more than the total trade creditors of the company, you kind of ask the question, well, there's a lot of dead wood here, and it'd be an opportune time to have a tidy up. So yeah, touching wood as always, but approval rates are holding steady. Loss ratios, sort of below, sort of nudging the 30% mark, so it's a manageable level, and I think we're quite pleased where we currently are. But it's always a big severity claim can make a big impact very quickly, and thankfully we've avoided those. And like I say, I think because the credit insurance sector has such a high penetration in this particular sector, it means that companies do see us as credit insurers in general as key stakeholders, and give us good quality information, and the golden rule of no nasty surprises. So give us the numbers if they don't look particularly good. Tell us what's happening and give us a bit of flavour around the numbers, and that always helps as well. So yeah, it's been an absolute honour and pleasure for me over the years to be underwriting on this sector, and I've always enjoyed the honest feedback and the engagement with NAS and the membership base, and yeah, it's been a real pleasure. Thank you very much, and I'm pleased to say that Nicole White will be stepping into my shoes on my early retirement. So very much welcome Nicole to the sector. I know she'll have the same level of engagement, and we'll maintain that great relationship that we have. So hi Nicole, not to put you under any pressure.
Thank you for your support, Shannon, as well. Thank you very much.
Well done, Shannon. Enjoy it, mate. Enjoy it.
Thank you very much. It's been an absolute pleasure. Thank you.
Nicole, would you like to introduce yourself?
Yes, just very briefly. I'll have to excuse myself. I've got one of these coughs and colds that everyone seems to have at the moment, so I'll keep it brief. So pleasure to meet everyone. Pleasure to attend today. I've already learnt so much. My background is in underwriting. I've been in credit insurance for, I don't know if I should admit this, but sort of over 25 years. I was with, before I joined what was Euler Hermes, or Trade Indemnity at the time, I was with a company that got taken over by Atradius. I was with Gerling Namur. So that was many decades ago. Started in Trade Indemnity as an underwriter, and have been, but predominantly been in the credit assessment side of things. So not a sector specialist, but learning so much already from Shannon and really making the most of this handover period that I'm really lucky to have with Shannon between now and his retirement. And as I say, looking forward to getting to know you all in the new year.
Fantastic. Thank you, Nicole. Roy, you have your hand up, sir. You're on mute, I think. Hold on, you're still on mute.
Oh.
That's better. No, sorry, Roy. You back up. I can't. I don't think your microphone's working, Roy.
Any lip readers present?
Your microphone is showing as muted, but I don't know whether it's actually working, Roy. It's not. It's not working. Put it up in the chat, Roy, and I will read it out. Right. Can I hand over to Jonathan Carruthers Green from MEPS, please?
Hi there, everyone. Hopefully you can hear me, see me.
Yes.
Yep, great.
Yeah,
okay.
nice one, thank you.
Just before I go into the most interesting part of today, which is all going to be about CBAM, I just got a couple of comments with regards to the safeguards, sort of that conversation that happened a little earlier. I fully expect the UK to follow along with the 50% tariff, so I've kind of got to agree with everybody here that's mentioned that before. I think the section where there might be a bit more flexibility is around the size of the quotas. So really, I think the fact we're going to end up on 50% tariffs is because we're seeing this alignment. Colin touched on it briefly earlier, but we're seeing the EU, we're seeing America, we've seen Canada, all sort of fall towards that 50% tariff mark. And I think that's because we're seeing sort of beginning kind of talks of some kind of global alignment on excess capacity. Obviously, there's this forum that's been going on for the past few years, but I think before they can really get any agreements with regards to that, there's got to be a little bit of alignment around these rules. And that's why I think we're all going to end up with very sort of similar tariff amounts. I suppose the advantage of that is there's the potential then for reduced tariffs within this group. So I don't think, so I think if we do see this alignment, there may be potential that further down the line, there's going to be exemptions between the Europe and the UK, or the UK and the US, that kind of thing. That's just all I wanted to add about the safeguards. So let me know if you can now see my slides. Hopefully you can see me grinning away there.
Yes, we can say that.
Fantastic. Okay. So we've only got a short amount of time, so I just want to be sort of very brief with some of the topics that I'm covering here today. Essentially just go through the things that we do know about CBAM and the things that are still very much unknown, things that are to be decided, things that we still need a lot more guidance on. But before we go into that, I just want to explain perhaps just a little bit of detail why there's still so much confusion about CBAM. So one thing I haven't mentioned on this slide is that it's been pretty much an absolute shambles by the European Commission organising and releasing the information around CBAM. They've had years to prepare for this, and today we are 7 weeks away from the point where this is actually going to start costing people. And part of the reason for this is that CBAM is just one small part of a whole raft of legislation that the EU's putting out to deal with and fight with climate change. This is something that's been going on for 20, 30 years now, and will continue going on for another 20 or 30 years. So expect there to be a lot more information released over the next couple of years, certainly around CBAM. The details around this are going to just keep coming sort of thick and fast certainly for the next few years. And part of that is due to the way that the EU's organised. There are lots of different organisations there that are involved in that. They've got the Commission, the Parliament, the Member States. All of those have to sort of come to some kind of agreement, some kind of alignment before we finally get to see exactly what the rules are. The problem is, like I say, 7 weeks today, this definitive phase starts. The match is going to kick off before we know exactly what the rules are going to be, which obviously it leads to a whole lot of uncertainty for you, and it makes it just that little bit more interesting for us when we're trying to sort of track what's happening in the market. The problem we've also had is with this essential radio silence from the European Commission, it's been left to people kind of like myself to really push that message out. And with the lack of guidance that we've had so far, it's meant to, there's been a lot of sort of mixed messages, and there's been a lot of information that's sort of incorrect. So let's try and sort of see what we do know about CBAM. And it's all the sort of fairly basic stuff. The key principles of CBAM, that's all in place right now. It's going to start in 7 weeks. Importers now have to go through a process where they need to register as authorized declarants. This is a process they need to do, otherwise legally they can't import CBAM goods into Europe. We also know that at least for iron and steel, only direct emissions are going to be included. So that's the emissions that are associated with the actual production of that product. And the way they're going to be charged is through a CBAM certificate. You can think of this as the currency of CBAM. Each one of these certificates costs around represents 1 ton of CO2 being emitted. And it's these certificates which are eventually going to go on sale. It's not until I think February 2027 that they're first going to be available to be purchased, and there's a deadline for submitting these of September 2027. So these certificates, there is apart from this period to begin with, where rules are slightly more relaxed, the certificates will be purchased quarterly, so there will be financial implications for anybody that needs to buy those. And then the other stage with these certificates is that they need to be surrendered. They need to be sort of cashed in, and that's going to be done on an annual basis. And the quarterly purchases, you have to maintain at least a 50% requirement from your estimates for your CO2 liabilities. This was brought down just a few weeks ago. Up until a couple of weeks ago, the rule was that you'd have to keep 80% of these certificates purchased throughout the year. And I think it just goes to show just how much that things are actually sort of changing and evolving, and they're still going to keep changing and evolving as we move into next year. So the next slide I want to show you is the things that we don't know about CBAM. Now, I had real fun trying to get this all down onto one slide, and let's be honest, there are so many other things that could have been included here. So really what I tried to do is just sort of hit the key points for what we still need clarified. As was touched on earlier, the EU benchmarks is going to be a really key to working out costs associated with CBAM. The CBAM benchmarks essentially provide this baseline for what we're assuming is clean steel production. If emissions from your supplier are below this benchmark, then you'd be charged around about sort of 2.5% of the emissions cost. Of this benchmark, then that payment then would be 100%. You can kind of think of it like sort of marginal tax rates flipping from that 2.5% to the 100% all around this benchmark. And as I say, that's such a key point, and the fact that we're going to be starting this process without this information, it's just ludicrous to me. But the Commission have promised they'll be available early 2026. I've heard end of Q1, I've heard mid 2026, but essentially that information isn't going to be available just yet. The other thing that we're expecting an update on is going to be default values for this definitive period. Now, you've probably had a mad rush to get the default values that were given for the preliminary period. Well, they're going to update all of those figures, and there is talk of them being country specific, but until we get this actual release from the Commission, then that's I can't 100% confirm that. The other side of things is looking at the actual emissions associated with the plants that you're purchasing steel products from. We need to be getting, ideally, their actual emissions data. And to get their emissions data, we need to be able to sort of verify this data. That we need to be able to actually go and check that the numbers they're putting in these boxes actually match the emissions that they're putting out. And the rules around that haven't been released yet. Just a few days ago, we did see a draft document, but that's subject to change. We're expecting a whole load of new information around CBAM being produced towards in December of this year. So a lot of this guidance around sort of the finer details is going to be released then. And that will also include some changes to how the CBAM and the EU ETS scheme are going to interact. We're currently expecting this to be phased out at the, we're expecting the ETS scheme allowances to be phased out at the same time and at the same scale that CBAM's phased in. The idea being that everybody's sort of charged the same amount. But like I say, the fine granular detail of all this is still yet to be confirmed. Also, details around third country carbon pricing, that's yet to be confirmed. The Commission's, once again, it's said that they're not looking to double tax this carbon costs, so there will be a reduction. But currently, the kind of schemes that are in place. We're looking at the UK predominantly. There are also separate negotiations going on about whether exactly how that will be aligned. The UK ETS scheme will be aligned back with the EU ETS scheme, because essentially they were the same scheme until we completed sort of the leaving the EU after Brexit, and there has been a bit of divergence there around exactly how those rules are going to be dealt with. So I think the other thing that I really want to sort of do today, as well as talk about these knowns and unknowns, is try and deal with some of the sort of the questions you may have. And Claire has already sent me a couple of these questions. So I'd like to just sort of hit those head on. So the next couple of slides are really going to just be trying to respond to those. And then if we've got a little bit of time after that, we can maybe take some more questions. So the first question that was sent across to me was around steel that was produced in the EU, processed in the UK, and then re-exported back to the EU. So first of all, steel produced in the EU will be subject to ETS costs, will be subject to the ETS scheme, the ETS regulations. So steel that isn't sort of processed too far shouldn't pick up any more CBAM charges when entering the EU. I think the key point to really sort of take from this, though, is that the importer that will be that you'll be selling to in the EU will need to prove the original origin of this material. So the certification, test, mill certificates, all of that kind of documentation is really going to become very important in this process. The next question sort of goes into a little bit more detail around exactly what we're saying when we're saying processed or not processed. So do we need to include our processing emissions when we're looking at exporting back into the EU? So CBAM, the scheme there, is currently implemented all using CN codes, HS codes. That's really the level that the Commission is assessing these products. So in answer to the question, does your processing then attract a charge? Well, it really depends on what kind of processing's going on. If essentially the CN code doesn't change, or only the very sort of the final digits are going to change, then really there's no actual sort of cost charge applied for this material. Once again, it's all going to be a paperwork exercise. You'll need to show that your material has entered under the same code, sorry, has left under pretty much the same code that it's entered. So once again, that sort of evidence chain is going to be absolutely key. If the CN code does change though, then it's considered to have gone under a new manufacturing process. And the embedded emissions of this new product should be declared when it re-enters the EU. And there would be potentially a liability for that processing, for that difference between it leaving and it returning to the EU. So those are the current rules. And once again, I fully expect these rules to be tightened up, the scope to be expanded so that more CN codes are covered eventually, and more fine detail on this processing reporting. The more fine detail on that will is where we're going to end up. So just moving on to this paperwork, there isn't any real sort of standardization at the moment of this paperwork. So really, it's the best approach I can recommend is keeping all the receipts, is keeping your paperwork as thorough and as clear as possible, as that's going to be essentially what's going to sort of prove whether you have or you haven't altered the codes. So I think at this stage, with the potential costs for minor processing not being sort of front and center, I think it's still this paperwork side of things that we really need to focus on. And then there was one more question that Claire sent across, and that was just with regards to UK CBAM. So of course, the EU CBAM will be coming in on January 1st. We're currently expecting the UK version to come in from January 1st, 2027. We did have some draft legislation which came out a little earlier this year, which I'm sure a lot of you have seen and commented on. And almost immediately after that legislation was published, there was a consultation launched to make sure that this legislation meets the intent of the policy. That consultation was completed in July 2025, and the results of that and more technical guidance on this is expected in early 2026. So believe that's going to be sort of sometime late in the first quarter, but as with anything, that's subject to change. One thing I would sort of comment about the way that the UK have implemented CBAM safeguards is they seem to have taken a lot longer than the EU, obviously because they started a little later. They've taken sort of longer to give their announcements, and it's also meant that the announcements can come very close to the date where this is all going to come into effect. So do keep an eye out for that. The other sort of key difference that we've seen in this legislative document is I think the UK has finally understood that some of the things that the EU do are a little bit sort of burdensome on the paperwork. They're very bureaucratic, and the idea of there being CBAM certificates isn't really something that the UK is planning on doing. So there's not going to be a purchasing certificates kind of scheme and then surrendering those. Essentially, the way the UK plans on operating it is as another tax. As another tax that's going to be applied onto these steel products. So really, for now, it's a case of just reviewing those supply chains. It's a case of collecting that data, getting that sort of structure for that paperwork in place, and then keeping an eye on the government guidance. We're expecting, as I say, we're expecting some more information from them very soon. So that's really all I wanted to touch on, and I hope I've just about kept us in time. I don't know if anybody else has any other questions.
Hi, John. Thank you very much. It does genuinely seem to be that it is still very much up in the air.
Yes. Yeah.
Are there no timescales at all, or are they just keeping it under the radar? And
sorry, are we talking about the UK one or the EU?
Both, really.
Both. Okay. Yeah. I think that this is going to be an ongoing, evolving thing, and it's not going to be a case of anybody able to keep up with the deadlines. The EU plans on bringing more products into scope for CBAM. Currently, it's those 6 major product categories, of which iron and steel is one, but they're looking to move that on to other products, other sort of steel derivatives, other sort of products that have a large proportion of steel, and these other sort of CBAM that contain a lot of these other CBAM categories. So I fully expect there to be a lot of confusion over the next few years, and I fully expect there to be a lot more guidance, rules, documentation coming out over the next few years. I don't think we're quite done with that just yet.
Right. Okay. Thank you. Does anybody else have any questions for John?
One thing I would like to say just before I do sort of hand back. I need to work out how to stop this presentation as well. There we go. Is that at MEPS, we primarily are looking at sort of CBAM from a cost point of view and how much it's going to actually sort of add to the prices. We don't know so much about all the compliance side of things. So we have recently signed up with IA-CBAM, International Association of CBAM, and got in touch there with a lot of companies who are looking at this compliance stuff in a lot more detail. We've recently held a webinar with one of these companies, DeBrink. I'll drop the link for that video in the chat, because we go into a lot more detail around sort of the potential cost implications for CBAM.
Fantastic, thank you. Do I take it we have no more questions? No. 5 minutes over with the information that has been provided. I've got to say it's been an excellent meeting for presentations. Thank you to everybody who has presented. Obviously, Roy, where are you? I think I speak for everybody to say, you know, thank him very much for all of his support and everything else, and good luck for your retirement, Shannon. So on that note,
thank you very much.
I will deem the meeting to be closed. Okay. Thank you very much. Thanks to everybody.
Thanks everybody.
Yeah.
Well done.
Thank you.
Thank you.
Great information.
Thank you very much. Thank you.
Thank
Bye.
you. Thanks all.